The U.S. life annuity industry continued to perform well in 2019, despite significant uncertainty in the macro environment. But the ability for insurance companies to achieve top-line growth remains a top concern in 2020, according to AM Best's latest Review Preview market segment report on the industry. I'm John Weber. Here to discuss the report is Stefan Holzberger, AM Best Rating Services Chief Rating Officer. Stefan, low interest rates continue to put a drag on life insurers' earnings. What should we expect from the sector going forward in 2020?
Sure, John. Well, we've maintained a stable outlook on the sector, so we do recognize that the low rate environment is a challenge, but we feel the segment overall is very well positioned to manage through those challenges. 2019 was a good year for the industry. ROE came in at around 10%. So, we do see some migration down the credit scale in terms of the investment portfolio, some more structured investments, more illiquid investments kind of coming through, perhaps more migration towards NAIC Class 2 investments. But we do feel the life and annuity segment is really taking a measured approach. They're adding some credit risk to their portfolios, but they're doing it in a measured fashion. Obviously, the equity markets were extremely favorable 2019, which has helped all of the segments within the insurance industry in the U.S. And, really overall capitalization is improving on an absolute as well as a risk-adjusted basis. So we feel insurance companies in this sector are well positioned to continue to compete and do well, offering the lower risk, lower capital consumptive index-based products.
Now, life insurance investment portfolios are trending towards less liquid and more high-risk assets. What changes to insurer investment portfolios are you seeing?
Yeah, that's right. There is a bit more credit risk inside the portfolios these days, and life and annuity companies are reducing liquidity overall. But again, I feel like they're doing it in a measured fashion. It's not really at a level that's a concern to us at this point. We are seeing more structured securities in the investment portfolio, more commercial mortgage loans, CLOs, whole bank loans, as well as increased allocations to private equity. We are seeing a bit of a scale back in terms of hedge fund investments based on somewhat of an underperformance of that sector relative to other asset classes. But again, we do see a fairly measured approach. There is a reduction in overall liquidity inside the investment portfolio, but in relation to that, we see improved ALM across the industry, as well as liquidity facilities through, for example, the Federal Home Loan Bank.
Should life insurers be considering ESG investments?
Right, so I think ESG is coming our way in the United States. It's clearly become a very hot topic in Europe. Some of the largest global asset managers are requiring disclosures from the companies whose investments they hold. I think BlackRock and State Street are examples who are quite proactive on the ESG front. Just as an aside, I think you might find it interesting to know that even in Europe, really across financial services, the regulators are very honed in on ESG. Even AM Best will soon be disclosing in Europe those ratings where we are adjusting the rating because of an ESG, environmental, social, or governance factor. But kind of coming back to the life and annuity segment in the U.S., we do feel that these companies don't have to take a radical departure to the way they run their business. Their investment mandates and investment guidelines do not need to change today in any kind of material way. ESG will probably first come in to the publicly traded life and annuity sector, where those investors, those stakeholders will start looking at the ESG scoring, how these organizations in the segment are scoring in relation to perhaps their peers, how they're choosing their investments. So, we really do think that ESG is something that's going to be gaining momentum. There's going to be more demand for the securities of companies that do score well from an ESG standpoint. So we think that it would be wise for the life and annuity sector to really kind of prepare for increased kind of exposure to ESG going forward.
The industry has been engaging in product de-risking for some time now. Is there a danger there in going too far?
Actually, we really don't think so. Our concern at AM Best is probably more in the other direction. Right. I mean, you're right. There has been a de-risking. Some of the most risky kind of variable annuity type products, long-term care products on the life and the health side have been kind of ebbing for several years. But, you know, the index-based products have had some really good successes in the market recently, but the markets overall have done extremely well. Unemployment is at a record low. So if and when we do see a dislocation in the financial markets and a bit of an exodus from these popular life and annuity products that we see today, that's where the pressure to grow could prompt some companies in this segment to start offering features and benefits that may not be fully priced in. So really it's kind of the converse of that. You know, it's a highly competitive market. Top line growth across all segments of the insurance industry is an important feature to the success of these companies. We're not saying that the companies would take a grow at any cost perspective, but again, in a competitive market, there is a lot of pressure to add features and benefits to these products in order to maintain that growth.
Now, the industry has a reputation of being a little slow on the uptake when it comes to embracing technology. What are we seeing in the way of innovation?
Right. So innovation and technology, you know, when we surveyed the industry, the participants and the respondents to that survey acknowledged that the industry, really all segments of the industry, including life and annuity, is behind the curve on that front. We don't see insurtech disruptors really coming in and taking business away from the traditional players in the market. It's much more of a collaboration and a partnership. And, you know, I think really that's the best way forward for the industry to kind of partner with some leading edge insurtech companies that can bring in solutions to these organizations. Some of the things that they're focusing on would be kind of the overall customer experience, cross-selling opportunities, kind of ease of use in terms of interacting with the insurance company. Straight-through processing for more straightforward products is really something that's getting a lot of attention. Could also be an opportunity to gain access to the middle market, which has been quite elusive to this point. And there are also ways to leverage technology and innovation to improve back office efficiencies, claims, and all sorts of other areas that we see gaining some attention. In terms of where the industry is today, we would really say that the life and annuity companies are undergoing this phase of building out their infrastructure, building a more innovative culture, allowing for good innovative ideas or technological solutions to travel through the organization and actually see the light of day. So right now, life and annuity companies are building the inputs to an innovative culture, and it'll probably still be a bit of time before we see a return on that investment.
Thanks, Stefan.
Thank you.
You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.